Hey everyone, Sean here from the Unicorn Ventures podcast, and thank you so much for joining me today. Today's guest has spent nearly 2 decades building the backbone of private investment in Australasia. Steve Torso is the founder of Wholesale Investor and CapitalHQ, two platforms that have connected tens of thousands of investors and raised billions through innovation, data, and community. From early scrappy beginnings to AI-powered deal rooms, I'm really keen to hear more about that. Steve's story is all about transforming the chaos of raising capital into a structured global system. Steve, thanks so much for joining us today.
Thanks, Sean. Appreciate having me on. Great intro.
Yes, thanks for that. Nailed it. Hey, look, one of the things that stood out for me, and I've been seeing a little bit more and more of it, but when we connected on LinkedIn, I saw this term wholesale investor. And it's something I haven't heard of before. And part of this podcast is educating our audience about all the new, I guess, innovations and angles and buzzwords that are out there as well. So I want to dig into that. But first, before we kick off, when you're at a barbecue meeting people for the first time, how would you introduce yourself?
So typically I just mentioned I'm the founder of Wholesale Investor, and it's a platform that connects sort of high net worth and family office investors with emerging growth companies.
Excellent. So what is wholesale investing?
So wholesale, it's actually a legal definition. So a wholesale investor is either technically a sophisticated investor, which as defined by the legislation is that they can invest, that they have invested 500K or more into an opportunity, or that they have an income of $250,000 a year, or they have over $2.5 million in assets.
Okay, and what can those assets comprise of?
At the moment, it can comprise of your home, can comprise of, basically your share portfolio, etc.
Excellent, cool. I like that. And I noticed that you said or. So
Yeah,
either
so
400,
it's
5,000 or,
correct.
yeah,
Correct.
that's
So even
cool.
if someone's got an income of 250K per year, they can technically qualify as a sophisticated investor. The other part is a professional investor definition. I think that's managing over $10 million. So wholesale investor covers both professional investors and also high net worth sophisticated investors.
Okay. So with Capital HQ and Wholesale Investor specifically, what problems are you solving for these people that have one or all of these things?
So typically people come to me when they want money, is the easiest way to put it.
You're
Like
the most
every day I
popular
get
guy in the
inbound.
room.
Yeah, inbound I get, when people are looking for capital, and it could be a property fund that, is basically taken on a mandate or basically decided to acquire an asset. Now they need to raise the capital for it. It could be the life science company that's going to be going through a series of capital raisings over the next few years. Like we pretty much work with, typically our clients are raising anywhere from sort of from 500K to 20 million, just really depending. And they're typically, um, right now, a lot of the companies we're working with are quite technical. We are working with a lot of sort of deep tech, life science, renewable energy sort of based companies, and we're working with a lot of fund managers. That's sort of the split of sort of the companies that we're working with at the moment.
Awesome. And not to put you in out of favor with any of your clients, but do you have a particular industry that you're just really excited about at the moment being involved with?
I don't have to get out. I put it all online what I'm bullish about. So look, I think look, obviously everyone's talking about AI, right? Which is the obvious one we've been talking about for 3 years ourselves as well. The one, and I literally did a post on it, I think it was this morning, or no, I've got a schedule for Wednesday. I'm very bullish about the potential role of AI across life science, medical devices, and just healthcare in general. Like
Yeah.
if you see a lot of the sort of there's a few different things that are taking place. There's like a convergence of forces that are taking place right now, which really sets up foundationally for it to be an important opportunity. And that is obviously the role that AI can play, whether it be the drug trials, drug discovery, the trial design. It can have an important role with that. If you look at the way in diagnostics for an area, it's been almost an unloved. There's been minimal innovation in the diagnostic space for decades, and now all of a sudden, you've got sort of the role that AI can play, where it can give, from a diagnostics perspective, there's a lot more solutions coming to market where people can have almost clinical grade, data or clinical grade information from personal devices that people are trying to sort of get regulated. So that becomes interesting, and I think the thing that excites me most about that, and I've experienced this where I've had quite a few family members experience sort of cancer, and ultimately sort of pass away, and you realize that the what's defined as the healthcare system is ultimately a sick care system, and I think this is a true opportunity to actually transform that into a healthcare opportunity, which is proactive, which is predictive, and which can actually have an impact in not just people talk about patient outcomes when it comes to healthcare. I mean personal outcomes that can actually significantly improve health. So that's a passion area of mine. Obviously, the renewable energy space, I think is we talk about that as a $1 trillion transition opportunity. It's quite significant, but my ultimate love sort of sits with the AI and the potential for what it can do for human potential.
Yeah, I totally agree. My first client in AI was in the life science industries out of San Francisco. And, when I was teaching myself about FDA regulations and how they set up laboratories and conduct testings and everything that they consult on, I was amazed and thought, oh, there's so much application opportunity
Yeah.
here. My
Well, the
wife.
FDA is adopting it and they're making it easier for companies to go through the regulatory process. So a lot of people had fears about RFK coming into this space, but actually they're now quite bullish about some of the changes they're looking to make.
Yeah, one of the first things we did we actually trained the model on the FDA regulations so that
Yeah.
their staff could reference off their own app and any questions that the clients had in the moment. So that's really cool. I think about my own experience with the healthcare system and predictive analytics and predictive AI in
Mm,
terms of determining what could happen and taking corrective measures. I think that's a fantastic journey and something that you should be bullish on. That's awesome. Thank you.
yeah. No
Uh,
problem.
I wanted to ask before all the platforms and dashboards came about, because you've had years of experience in this particular industry, what was it like in the early stages of being a founder?
I think being a founder, it's not even just early, it's being a founder is hard. There's no doubt about that. But I think what was really hard about when we started was there was no ecosystem. There was just basically there was three operators sort of at that time. Like there was the Sydney Angels group, there was what is now Cicada Innovations, and that was pretty much about it. So there was no real ecosystem. It was very fragmented in how it sort of operated. And it was basically the industry runs on a mate who knows mate sort of level. So for us to bring that together, put it into a platform perspective, was sort of quite new at the time. And it's so funny. I think about now, like we've been doing this for 17 years. We technically still don't. I technically cannot tell you who would be our competition. Right? There's other people in our area, but got different models to us, have different approaches, but and that's when you realize like it's a very hard space to crack, and we had to create our own path with everything from. I think that's one of the best things about AI and just general like listening to podcasts is you can take advantage of other people's frameworks. When you have to
Yeah.
build your framework from scratch, it's very, very difficult. And that's what I think is so great about now. Like this has to be, I think this is the best time in the last sort of 20 to 30 years to be building a startup, and I think that's something to be very excited about.
Yeah, when I look at what you've created in terms of the ecosystem itself, but the platform in which you operate, but in what you're talking about, and so quickly in the pulse of the moment, it really impresses me as well. And I know you have some findings you want to share, some really recent findings
Mm.
to share with our audience, but you're also taking advantage of AI like Google LLM to process large amounts of information and create it in a way that is easily digestible. So I think what that for me is something that's standing out in your content as well. Valuable information, easy to understand, and positioning yourself in a different way.
The next layer for us is really focused around how we help our clients communicate what they do. There's actually a big gap. If you look at capital raising is one of the most frustrating areas. Like I've been doing this now, I said for 17 years. I can count on one hand how many people tell me that they like capital raising, right? Everyone hates it, right? Because effectively you're going out there and you're just getting endless rejection. Like it's the equivalent of, going into an online dating platform, putting up your profile, reaching out to 100 people, getting 97 rejections. And in those rejections, you're getting ghosting, you're getting told why you're ugly, getting told, different reasons why you'll never make it. Like it's a brutal process, right? And
Yeah.
I know that everyone likes to highlight the sort of, the sort of glamour stories, but that's not representative of the sort of 99 out of 100, 999 out of 1,000 sort of stories that companies go through. And there's this massive disconnect between what the startup media pitches people about what capital raising is like versus what it is actually like. So the benefit for me is before starting WI, my background was marketing, right? If you think about a capital raising being basically a marketing and sales process, it then puts everything into perspective. And it helps you understand that the first thing you got to do is build a pipeline, and then the second part you have to do is actually run people through a process to convert that pipeline into a shareholder. And in that, you realize that your business is the product, right?
Mm.
And that's a bit of and because the reason that's an important distinction is because otherwise, when you're going through a capital raising, it's a super emotional process. When you're getting yeses and nos from different investors, when you get a yes, like investor's going to go ahead, you feel like you're bulletproof for the moment. When you get a no, you go through all sorts of doubts, in your head. Like it's a wild, but if you can reframe it to yourself as to being that type of sales and marketing process. So if you think about that buying process, it's awareness, consideration, decision. Well, everyone's been trained, whether it be through the different accelerators they go to, through startup media, that it should feel like awareness to decision. Everyone forgets that consideration process.
Mm.
So the big part I love to educate sort of founders on is to think about that consideration process and then tap into the other laws that you learn in sort of marketing and sales, laws around like mere exposure effect. Like if I see Sean, the AI guy, pop up 9 different times, like when I look at your previous episodes, I see Jordan Green, I see, different people that I know, like, respect, etc., sort of that have done it. All of a sudden, just I've had the mere exposure effect to your name, right? I can remember it, and then I see other people connected to you. Then suddenly I've got social proof validated inside my brain. And
Mm.
so no one really thinks about these elements when it comes to a capital raising standpoint, but those are some of the things that can actually cut through the noise and become signal for a potential investor. And so simple stuff like that, I think can make a big difference when it comes to a capital raise. So the why I love AI so much is I want to build that into our product where it's actually doing that on behalf of the company. And the mere exposure effect part of, someone said when someone sees your name 11 times, they actually start to notice you. Do you know what I mean? But
Yeah.
most founders are like, well, you see me once. What are you thinking about it from the investment perspective? So we spend a lot of time reframing how people think about the capital raising part, and obviously we want to do that. We want to productize that in what we build going forward.
I think that's such a fascinating angle, and it's ticking so many boxes and setting the green lights in my head. It's you're so many people looking for capital raising are asking people to marry them on the first date without even
Yes,
careful consideration if they're the right partner. I don't know if it
yes,
reeks of desperation or they just haven't given it the consideration of, um, they spend so much time understanding who their ideal customer is and how their products and services can help, fulfill their needs and then dreams and aspirations. But something you said there that just really nailed it for me is that your business is the product, not your products and services. But when you're
hmm,
talking to people that you're seeking capital from, it's your business that's the product.
correct. And that just helps you reframe inside your own head about how you should be thinking about your raise. And I'll ask you another question, Sean. I'll go on the other side. So, what are the typical stats that people put out about how many opportunities that have, if a VC looks at 100 companies, how many do they typically invest into?
Well, I could very few, and the people that I've been interviewing they've told me they've seen everything from 500, 700 a year to 2,500 a year, but they'll probably only make one or two investments a year, really, and depending on the level of investment and their involvement as well.
Yes.
But then they're also expecting to lose on half of them. So they're becoming very diligent about which ones that
Well,
they're
I'll go
picking.
even further. So the common stats that get thrown out is 1 in 100 to, and I've, that 1 in 1,000 I've also experienced as well. Then the
Hmm.
next question then you ask is, well, how many actually experience follow-on investment from that same VC? So that, let's say they've brought in money and then all of a sudden they need to go and raise again. How many often get follow-on funding from those same VCs?
Okay.
And that's when you start to put numbers in perspective. So the common thing that I'm educating people on is this space. What I outlined, that pitch deck scenario of the creation of a pitch deck, send it to an investor, wait for a reply, that model has been structured and geared to suit how VCs like to see opportunities.
Yeah.
But the challenge is if they're only investing in 1 in 100 to 1 in 1,000 or, etc., who's actually investing into all these companies? And ultimately it lands on the high net worth and the family offices.
Yeah.
They have been the biggest investors in this space. They don't get the headlines for it. They don't get the media coverage for it, but they're actually the biggest supporters, especially in the technical business, especially in the early stages, etc. Right? But we sort of glamorize when event, and that's great because they got PR departments that are aligned with the media to sort of talk about that. Then they do their own ecosystem building, etc. But there's so many companies that raise capital from high net worth and family offices, but yet there's little education about how to actually engage with family offices and high net worth from a capital raising perspective. But yet it's really the backbone of investment into early stage companies in Australia.
You're absolutely right. I'm thinking about the real estate industry. I'm thinking about self-managed super funds, and sure, there's the big players out there, but there's so many high net worth and family funds out there that are, creating such a huge market. But I can't think of any marketing that's actually structured to them other
Well, just
than,
go and ask just go and ask some of your friends that have built startups that are actually like for the ones that typically haven't raised from VCs, they've typically raised from high net worths or family offices, especially in the early days.
yeah. So is that for you? Where was that light bulb moment for you? Because I feel like that is a
Well, there
genesis.
was no VCs when we started. There was like five VCs and they were all government funded when we started. So it was more we started dealing with the high net worths and then the VC ecosystem started to build around it. But
Yeah.
also at the same time, there became a lot more deal flow that sort of come out. But it's just been my observation, over the years of working with companies is that it's said people do not give enough credit and value to the role that family offices and high net worths have played in funding the Australian innovation ecosystem. So VCs have done an incredible job. There's been some great success stories. And, I hope we have more of them. I hope we have more success stories coming out of them. But also, I do want to give credit to basically the investors that participate. And interesting enough, in our survey that we just did, that I was sort of referring to you about, I did a breakdown of asking the investors how do they position themselves, and it was interesting enough. Out of the people that responded, 25% position themselves as a founder and investor. So it's
Mm.
interesting that there's founders that are also investing into companies as well. And then you find, I think it was like 15% were advisors or industry participants that were also investing into companies. And so this is how the ecosystem has actually self-built itself by actually investing into other companies themselves.
Each other. And we see it up in the on the higher end of the street there, like BlackRock's invested in,
Hmm.
in one in their and Apple and Apple's invested in them and so forth. They're all supporting each other. I mean, if there's a key to success, shouldn't we be following that model? I
Agreed.
mean, supporting each other. I mean,
Yeah,
yeah.
yeah. No, but
Um,
that's how ecosystems get built. Like the biggest thing that Australia needs to have is it needs to have more exits, right? Like
mm,
for example, if an Air Wallex goes to an IPO, then all of a sudden you have a lot of different VCs, a lot of staff actually going through exits. If Canva goes through an IPO, when they had their, when they actually did their secondaries, like if the more of these exits that we have, and that's been the lockup over the last 3 years, is there hasn't been as many exits sort of take place. But the more exits start to take place, what's going to happen is people get that money. Yes, they go buy property. Yes, they go buy some stuff that they dreamed of sort of buying or do things. But at the same time, they typically reinvest it back into the ecosystem as well.
yeah,
And
'cause
sometimes they
they
go and
want to
do
know if
their
they
own
can do it
startup.
again.
Yeah.
Yeah. Yeah. Okay. So yeah, they want to know if they can do it again. They want to do it with their own startup. they've seen the benefit of how it's changed lives for others as well, and they want to recreate that. Um, when you first started building your platform and ecosystem, who were the people that were the loudest supporters and who are the loudest skeptics for what you're trying to
Jordan
create?
Green was one of them, actually. Jordan Green, I will always take my hat off to. He was an early supporter right from the start. Tim Trumper was also incredibly supportive. Ruben Buchanan as well. Dominic Carosa. Like these are all sort of industry like legends in their sort of own area,
Yeah.
and sort of may not be well known to this sort of generation of entrepreneur, but for our at that time they were all sort of incredibly impactful. The other one I'd say that I'd take my hat off to is someone like a Roger Allen, who was like the sort of first VC of, Allen and Buckridge. Like he was the Airtree and Blackbird of that time when we were starting. Like guys like that really paved the way. I don't think we really had too many detractors, to be honest, when we started. Basically a lot of people just said that that was logical, because all we were doing was we were just taking a curated approach to building a marketplace of opportunities for high net worths and just aggregating a database of high net worths and family offices. And as I said, it's still like that endless curation is one of the key parts to what's allowed us to get the traction that we have, to build a global investor database, to be able to do conferences, across Australia, Singapore, UK, Dubai. We did our first India one at the end of last year. And the more you go overseas, you realize this marketplace is global. The opportunity for Australian companies is global. You just have to have the courage to go and test your potential. And, people typically know what markets their opportunity is going to resonate with. So go and test it, go and test out what that potential is. But for me, as I said, whilst it's an incredibly hard space, I think one of the things that we accidentally built was the ecosystem. Initially, we just focused on building a database. The events, the in-person part is very important to that building of the ecosystem, because really, if you think about if someone's investing 50K, 100K, 500K, etc., they do want to see the whites of the eyes of the person they're investing into.
Yeah. So tell me about the events because we were talking offline about the number of events that you had, and congratulations in going overseas. And I've heard India is just one of those untapped monsters of
Yeah.
opportunity for Australia as well. Um, so back me up here. Why did you start the events and what were the flow-ons? You mentioned build your ecosystem, but how? What is it that you're talking about? Why are people coming to the events? What are the many benefits to them, but also the mutual benefits to yourself? But
Well, there's three things we promise attendees to our events. Number one, they get access to insights from leading investment minds. So whether that be VCs, private credit, private equity, crypto, etc., we want to give them access to their insights because people typically have their own thesis. So it's an opportunity to either update that or, confirm what they're already thinking. The second one is access to curated opportunities. So we actually showcase the companies that we work with. They get the opportunity to pitch their business, they get trade tables to network with them, etc. And then the last part is the high value networking. So high net worths want to meet other high net worths. Family offices want to meet other family offices. They all want to know what each other are doing, what they're looking at, what they're investing into, what they think about the markets, etc.
mm. And was it when you first started out, was making that decision of high net worths in that niche conscious decision, or is that where you started, or was it an evolution of your journey?
I was just where we started. I've
Yeah.
never wanted to go into retail, even when they were bringing out equity crowdfunding. It was never my interest to go into that market. Like I
Why
think
is that?
it just never interested me.
Yeah.
I find it interesting. Basically the people I get access to because of what I do is just ridiculous. It's crazy for me. Like we've got 10, I think it's nine or 10 family offices as clients because they're raising capital for various projects. That's a great a great path. We've got top private equity firms as clients. We've worked with sort of some of the known VCs as part of their capital raise. It's far more interesting for me, and you find that better deals want to raise money from high net worths or family offices, or typically they want to go up the line and get insto money. But they're often looking to raise from high net worths and family. So it sits really well with the networks that we want to build, the opportunities we want to have access to. And it's interesting enough, we get most of our referrals from our investor ecosystem. So
Mhm.
it's typically companies that participate in that are doing their next round, they refer them over to us.
I was amazed when I started this journey, and just for a bit of background, why I started Unicorn Ventures is because I had zero knowledge about this world that existed. I didn't have a network, but I was really interested. I wanted to know how businesses could raise capital. What was the difference between a private equity firm and a venture capitalist? I just didn't know. I didn't have that education or background. And when I started reaching out to people and asking the questions and getting them on the show, one, I was pleasantly surprised of how genuine and passionate everyone is, but also how generous everyone is. Jordan Green, Dave Kenny, everyone has just been amazing in what they've been sharing with me. But the third one is, they can be all that way with just me. I'm just a guy, right? And wants to ask some silly questions. But the support that they've given each other and the way that the networks are involving each other's in an opportunity as well. Hey, we got this opportunity and sharing it with another network. I
Yeah.
just find that so fascinating. It's not as competitive as I thought it would be.
It's competition.
What's that cooperation, competition?
Competition.
Okay, I
So
like that
cooperating
competition.
and competing at the same time.
Now, why would people do that? Like, what's the benefit to that?
Because you want to grow the ecosystem.
Yeah,
You got to remember the last 3 years, the ecosystem's been shrinking, right?
right.
Because less people are being hired in the space, less money's being raised. That means less people are being hired. Government funding started to be reduced from it, etc. So therefore, that has a shrink. And the reality is, the only way you build an ecosystem is if you actually, engage and cooperate with each other. Now, it doesn't mean they're technically actually competing, but the way this space builds is by collaboration, not by isolation.
I love that. I think that is so important, so powerful. But I also think it's going to be a shift of change, not the way that people operate, but when you say the space is shrinking, I just have this feeling that the general market out there of high net worths or family, that are moving into self-managed super funds, they've had enough of big corporations. I think a lot of big corporations globally have lost a lot of face, and the trust value is going down. So I do think that there is this desire. I want to be part of it. I do want to invest in the future of myself, but I also want to invest in something I believe in. And I
Hmm.
think that's this market and where everyone's operating um, is really exciting and presents a really big opportunity over the next couple of years in particular.
Well, many that invest in this space also want to add value to their investments, whether it be by introductions to other investors, whether it be, advising and giving guidance from time to time. Like, for me, shareholder support has been invaluable in how they've sort of helped me guide, tricky situations. And I think a lot of companies sort of experience that the more you sort of work with shareholders, some aren't, some can be sort of just, passive. Others can be challenging, but you find on the majority they're quite supportive and can be very, very helpful.
You dropped a piece on LinkedIn not too long ago, and it's from your recent survey as well. But the four questions that every investor is asking themselves at the moment, can you share with our audience what that is?
Sure. So basically, one of the key things when people are actually thinking about sort of capital raising, they're always trying to understand what is an investor thinking about when they're actually coming into the conversation, right? And the founder gears themselves up where they're just ready to pitch. They're ready to go out there, they're ready to sell basically what they're doing. And what we sort of highlight is that effectively the key parts that they're going to be sort of talking about in advance is number one, the valuation, right? They want to understand how you actually arrived at the valuation that you got to. Number two, they want to understand what does the actual business model look like? What is the growth? What is the go-to-market strategy? What is the current, if it's in revenue at the moment, what is the actual unit metrics, etc. The third part they want to understand is like, what does a potential exit look like? And this is interesting is because for a long time, talking about that was almost something where it was frowned upon in the VC ecosystem. But now all the
Really?
VCs want exit, so all of a sudden we're happy to talk about it. So it's a but so that's that one talking about exit. So what does that exit scenario potentially look like, or what is the likely time frame? And then for the technical businesses, it is, what do the de-risking milestones look like? Like, they're typically the four things that investors are thinking about. The fifth one, I think that's really important, is how does the use of funds correlate with the top three growth drivers as well? I think that would be a fifth one that if I was to add to that, that'd be an important one for companies to think about when they're going to a capital raise, is how does that investor's use of funds contribute to the growth of the value of the business, right? And what is that direct correlation? And if you're a revenue producing company, it's about what are the three key growth drivers. If you're a technical business, is what are the technical milestones that you need to de-risk? Is it data related? Is it regulatory related? Is it, the prototype related, etc.? So they're the sort of key things that investors are thinking about subconsciously when they're looking at a deal. And also, one other thing for your audience is, when people pitch an investor, they're asking for money. And in their minds, the only thing that the investor can lose in investing into your company is the money. But there's actually four things that an investor can lose by investing into a company. Number one is money. Number two is time. Number three, it could be reputation, as you've seen with the likes of sort of like the Strong Room deal and EVP, etc. The fourth one is the one that most founders don't think about, and that's opportunity cost. So if an investor puts 100K into your business, and let's say you go sideways or whatever, or you go up a little bit, if they had access to this another opportunity that they could have put their money into, and that's gone in 10x or 100x, that's their opportunity cost. That's the competition that you don't know about. So there'll be some other points for your listeners.
I love that. And I think you're absolutely right about the opportunity cost. Is it's not an endless bucket. Investors, it's it could be their hard-earned money that they've built up over their career, or it
Oh,
could
it's
be
always their hard-earned money. Most of the time, their hard-earned money.
Yeah, so it's not like an endless bucket. They have the right, to scrutinize and be, very careful about their decisions. But that opportunity cost, I've heard that pop up quite a few times of late. When you think about exits and people determining, well, how long am I in this investment for? Are you seeing any trends? Some people said, expect 10 years, and some people are saying 5 years. Some people say I want to be out in
Yeah,
two,
I've actually got the data on it, 3 to 7 years.
3 to 7 years.
3 to 7 years. So the actual, let me just find it. Yeah, it's basically 3 to 7 years is the sort of time frame that most investors at the moment are expecting for an investment.
And I believe that's come back a little bit, but is that largely because of the speed of which AI and automation is running, do you think?
I'm not sure. I have to do a follow up on ask what is their motivation behind that. I would say the other reason why, if you think it's come down, the other reason why it might have come down a bit is because people haven't been able to get exits for the last couple of years.
Yeah, right. Yeah, it could
And
be.
so what that means is, if they're not getting exit, that means they can't redeploy. They can't realize the value of what they've invested into. So that's where you got this situation where you got lots of money deployed. You got VCs talking about how much, cash they're still sitting on, but actually they need to get those exits to then also redeploy, into their next opportunities.
Yes, that's what instinctively I'm thinking. It's between opportunity cost, but also the speed of which AI and automation is moving so fast is that the problem we're solving for today, and we can see a roadmap for 2 to 3 years to get it to here. But beyond that, we don't know what's going to happen out there in the world. So it's kind of like, yeah, let's just aim for that and go for that. That's what I'm thinking at the moment. Has there been, you mentioned there's probably a handful of companies that nailed the pitch and you've gone, wow, okay, amazing. Has there been any instances where you've, uh, been talking to a founder about an investment and they nailed the first four questions, but then you dug a little bit deeper and you felt like, oh, there's just nothing really of substance there?
I'll
And
tell you,
I won't ask you
I
to
won't
name
say
them.
that. I won't say not a substance. I'll tell you a real example of. So there was a company we were working with, and they're in the renewable energy space, and we took them to Singapore, and I introduced them to a family office contact of mine, and I did the introduction, and then it was a few months later, And the family office, I was just having a catch up with him. He says, "Oh, I just want to give you feedback about the company you introduced to me." I said, "Sure." And he says, "Well, basically, we really liked the initial conversation. We liked what they were doing. We decided to, basically ask some simple questions about, that we sent them through a list of questions that we had about the opportunity. And then we didn't hear back from them for 3 months."
Wow.
And that's a perfect example of where founders go wrong. And that's one of the hardest things about what we do is we don't have any control over what a founder does or doesn't do. That stuff can kill deals,
Yeah.
really kills deals. And that sort of experience that they had was also a similar experience to what we had with this sort of same company. But that becomes frustrating, right? So I would say the simple thing is that if you're setting up your capital raising, build it up to streamline and simplify it. Think about the way that Netflix destroyed Blockbuster, right? Why? Because they made everything on demand that you could access straight away,
Mhm.
right? And effectively, lack of efficiency kills in this space because every investor that you're pitching to, you're competing with anywhere between 5 to 10, 15, 30 other opportunities. And if you're not getting them what they need, then you will be removed from their top of mind headspace, into it. And so simple thing, so as far as a simple principle is when you're planning your capital raise, set it up so that make it simplified and efficient for the investor, and they can get access to your frequently asked questions. They can get access to your documents. And anytime you get asked a question more than sort of 2 or 3 times, you can turn that into a frequently asked question, or you can create a document so that that investor doesn't have to ask what other investors have asked beforehand. And the
Mhm.
more you do that, the more you'll find that your conversations that were previously going from 3 hours, 4 hours, 5 hours, 6 hours, multiple coffee catch ups, all of a sudden start to be reduced.
Yeah.
And so
Because
that
they're
would be
getting
my
access.
simple guidance.
Yeah. When did you discover that you're being more than, a matchmaker platform and really providing the infrastructure and the plumbing for this ecosystem for the private capital markets?
I would say I'd say 2019, 2018, 2019 was probably a big year that really sort of transformed how I think about this space. And it
Mhm.
was because I started to go through my own capital raise, and it was the first time I'd gone out to my own database, and I started getting advice from everyone. And then I realized that whilst everyone was sort of well intentioned, there was only a really few people that were giving me the real feedback that I actually needed.
How
And
did
I
that make
remember
you
I spent
feel?
months and months going around in circles on a deck, on a pitch deck. And then you ultimately realize the pitch deck plays such a small role
Yeah.
in the process. So that's when I got really head on into what is the actual science and art of the capital. Because when you hear about capital raising, everyone makes it feel like it's this mysterious black art, that's an advisor or that's paid to do capital raising, and really it's just a process, no different to marketing and sales, as I mentioned before. It's just a process. So that's when I went head on into understanding what is that process, what are the key drivers, and I'm just lucky I'm surrounded by people that I can get some really good insights on that. And that's when I started spending a lot more time on education about how to present yourself, what is the actual process to run, how to do follow-ups, all that sort of stuff, how to create, the stuff around the mere exposure, how to create multiple touch points for an investor. So bringing stuff that you learn about marketing and sales into a capital raising focus.
Uh, how did that make you feel? You're 10 years into um, into your business, and then you're reaching out to the network that you've actually built all these relationships. Was it a humble pie, or was it a gap of, oh, wow, there's still so much I need to learn? What was it for you?
Um, Definitely, there was so much I need to learn because I realized I only knew one part. I only knew promotion of a company. I didn't know the full end-to-end process, and also it was awkward. It was an awkward thing going out to ask. It'd be like you going out to your audience and trying to sell them a product, right? Like you feel awkward to do it to start with. but then you realize that there's people that want to participate. So really my job is to remove my awkwardness and give people an opportunity to engage and participate if they would like to.
I love it. It is like dating. I feel that more I'm learning and having these conversations and
Yeah.
never ask anybody to marry them on the first date. Answer all the questions that are in the back of their mind, like, is this person a psycho or are they going to take advantage of me? But also, it's kind of like, hey, I was wondering if you're up for it. Oh my God, I've been waiting for you to ask. Yes, thank you
Yeah.
very much.
Yeah.
Um, I wanted to ask about it is relationship building, right? And as I've just given
Yes.
that, but what you just said before is that in the beginning it was about who you knew, mate to mate, and so forth. But there seems to be in that example that you just gave with the family business, sending through a list of questions, there being a process. How much is data and structure in the process becoming more and more important in this in today's day and age to where it was, say, 20 years ago?
Oh, it should be like 20 years ago, people were sending out long form IMs, as part of their pitch. They were sending out 30-page documents to investors to read about an opportunity. Now they're just getting a pitch deck, right? So like the actual process is vitally important for an investor to go. And the best way to think about it is that pitch decks get pitch deck headspace. They get seconds of attention. I think what's more important now is that when people talk about a data room, I said everyone likes to sell this idea of the data room. Well, the reality is your potential investor is likely connected with you on LinkedIn. They're seeing what you're sharing on LinkedIn. If you're going to send out a video of you sort of talking about your updates with your business, they're likely going to watch it. So what's more important is about creating information that they can access when you're not speaking to them. So if
Yeah.
it's 10 p.m. at night and everyone's in bed and that's when they want to be researching you, what they that's when your information needs to be available for them to have a look at. So the structuring of a deal room is vitally important for a company and their success, because if they don't have it and they have to rely on just getting that information from you in person or waiting for replies to emails, there's two things that kill deals: time and lawyers. The first one will be at play.
Yeah. And oh, so how have you been using AI in your platforms to help your clients in those
So we
situations?
did it for matchmaking, but
Yeah.
more what we're using it more now is helping companies communicate and articulate who they are and what they do.
Yeah.
But that's our next stage, is to productize that. So in the next 3 months, that's our sprint, is to basically productize, really sort of auto drafting, across a range of different areas for companies. Because as I said, I can speak with a company and within 30 minutes I can articulate what they do to a potential investor better than what they do. Right.
Yeah.
But that's because I'm trained in that. That's how my brain thinks. So to productize that, well, basically the idea is that it's like, well, how do we save that cognitive load of what founders are always thinking about from a capital raising perspective? It's like, well, an investor's expressed interest. What should I say? An investor's already checked out my deal room. What should I do with them as the next step? If I'm going to set up my deal room, what information should I have in it? If I can help them save that cognitive load and basically utilize their own material to help create that, that will be a game changer from this space perspective, because most founders don't want to be out there raising money. They just want to go and build their business. So
They
that
just
means
want
everything they
comfort.
do in this area, yeah, everything they do in this area is a pain in the butt, basically.
Yeah. I was thinking like a lot of different founders will want different things from AI and the support, but what I'm loving, and I was thinking about this morning, and what I'm loving that you're doing, let me finish that thought. I was in the shower and I was thinking about first principles of
Yeah.
business in sales, marketing, operations, and so forth. And I just thought it's amazing how many businesses forget about first principles when they're considering AI and automation in their business. They think it's something else. They don't think about how they actually support each other. And you don't throw this away just because you're attracted by the shiny ball. you actually use this to leverage and build stronger connections and more operational efficiencies and engage better than you've ever before. So I'm really excited to hear about how you're using your marketing background to help businesses get their messaging right in the first place. Because that's, and I've heard this from a couple of guests, um, from Dickie Kerr talked a lot about this as well. So if you don't get that message right, if you don't get the attention right, it's like Shark Tank. If you're not nailing the person within the next 30 seconds and can't articulate it, then you're just missing that big opportunity to really grab the interest.
So let me break it down the simplest way to think about it. And I know, apologies, I've only got sort of 6 minutes, but
You're right.
basically the first part is hero text. What is your 3 to 7 hero text, word hero text about your business? The second part is your problem, your basically your elevator pitch, do you know how what we do is pitch? The third part's the most important, and all these three take place before someone ever sees your pitch deck. The third part is about your social proof elements as it relates to raising capital. So your social proof elements as it relates to raising capital are, number one, who is the team around you? What is your team's been there, done that experience, including your own? Have they built and sold businesses? Have they worked inside the likes of Canva? Have they worked with Google? Like, what are the brand names that every one of our brains is looking for to take something from unknown to known? So we
Mhm.
need someone to help us cross that bridge. So from a team perspective, how do you articulate the team's been there, done that experience, that they are the ones to execute on? The second part is who else has already invested into your company? And if you haven't raised capital yet, how much have you invested into your company to show that you've got significant skin in the game, and not hours spent and lost salary? I mean, actual money into the company.
Mm.
The next layer is, and this is more for the technical businesses, is what grants have they been able to access? What grants have they received? Because they typically would have gone through some sort of technical due diligence as part of that process, right? Likewise, understanding who's already invested into the company, they would have done some sort of due diligence before they put money in, right? So all these things are social proof layers as it relates to capital raising. If it's a B2B business, they need to be selling who are the clients that they're working with, right? Because once again, they would have gone through a procurement process and they won, right? So therefore, it shows that there's validity to what they're doing from a product perspective. If they're a
Mhm.
B2C business, they've got to show their validity in traction metrics, right? B2B also has to do that as well. And then there could be other things like industry awards, etc. But those are some of the key social. So the biggest thing to think about is when people are thinking about investment highlights, your brain should trigger, I need to show my social proof elements as it relates to raising capital.
I love that. I love that. And I love that you broke it down like a checklist for our audience as well. That's really cool. I love that a lot. Hey, walk me through what do you think the future is for private capital? Because I know you released a post on this a couple of weeks ago as well. What founders and investors really want. Where do you see it going?
So Larry Fink actually he did his chairman's letter, and he actually, like, the way I think about it is BlackRock basically just set the tone. So he put out his chairman's letter. The future of private markets is likely to be more products for high net worth and family office to get access to. I would say also the focus will be the tokenization of it as well, and also potentially providing retail access to this space. But the
Well,
private market.
let's just break that up a bit. Some of our audience may not understand tokenization and access products. So what does that mean specifically?
So basically, if you think about, so if you look at the where they're investing, BlackRock has invested in solutions sort of built, I think, on Ethereum, where different assets can be tokenized.
Mhm.
Rather than sort of going through a normal sort of equity structure. Well, they're still using equity, but they're tokenizing it to make the sale and the transfer of it a lot easier than what it would be otherwise. So it's basically done on the blockchain, and there's different models that people are using for it, but the tokenization of real world assets has become one of the biggest trends over the last sort of 18 months. And
Mhm.
it's also becoming institutionalized as well. So I think that's a big one for private markets. Look, I think my personal belief is I think right now is the best time for investors who are interested in growth, and high yield opportunities. Private credit for the high yield and also even access to growth. Obviously innovation for high growth opportunities and private equity for growth. Like all of them are primed to take advantage of what's coming down the pipeline from an innovation perspective. With the private credit side, I just can't see Australia's interest rates coming down over the next, sort of 12 months, just given the sort of higher for longer environment. So therefore that creates opportunities for private credit.
Yeah, I totally agree. And I think with the cost of living that everyone's been experiencing the last couple of years and stress in real estate market for some, not for others. Yeah, I think that is absolutely primed. People are looking for alternative options for themselves.
Yeah.
I love that. Um, Thank you. I got three rapid questions for you before we wrap up. If you still got some time.
Go for it.
All right. One decision and journey that you're most proud of as a founder and ecosystem builder.
Starting this business.
Nice. Um, can you walk me? Okay, I know it's a rapid fire, but like, was that an instant thing, or was it a 9-month thing, or when you made that decision of starting your own
It was about 2-3 month exercise.
Okay, cool.
Yeah.
I think that's a separate conversation because I'd love to pick your brain on that one. One big mistake or painful lesson you'd love for other founders to skip when it comes to raising capital.
I would say when you've raised money, avoid the pressure. Basically, you have pressure to then invest that money. So the big mistake we made was scaling too quickly in 2021 and 2022 because you expect the money will always be there to raise, but when it's not, it's painful.
Okay, I like that. Complete this sentence. The future of private investing will be
global, digital, and probably tokenized.
Love it. Okay, cool. Steve, thank you so much. I love following you and absorbing your content online, but where can people find you or learn more about your events and if they want to get in contact with you?
So they can go to the Wholesale Investor website, CapitalHQ website, or they can just visit my LinkedIn, which is Steve Torso.
Beautiful. Our time went by so fast. I feel like I've still got another 30 questions I'd love to ask you. So hopefully we'll get the opportunity to catch up again soon.
Thanks, Sean. Appreciate it.
All right. And for the rest of you, thank you for joining us this week on Unicorn Ventures Podcast, and we'll see you on the next episode. All the best. Bye.